My name is Danielle Foster, and this is the story of how my ex-husband tried to walk away from our 14-year marriage with nearly a third of our combined assets quietly moved out of sight. And how one forensic accountant, a stack of bank statements, and my own refusal to simply accept his version of what we have turned his plan into the single most expensive mistake of his life. I want to start before the betrayal, because I think it matters to understand what 14 years of an actual partnership looked like before I tell you how it ended. I met Ryan Foster when I was 26, working as a hospital administrator, and he was finishing his MBA while working part-time at a regional investment firm. We built our life together in the way most couples do, slowly, through 100 small decisions rather than one dramatic one. We bought our first house together. We had 2 kids, Emma and Wesley, now 11 and 8. I scaled back to part-time work for 6 years while the kids were young, an arrangement we discussed and agreed to together. One that made sense at the time given Ryan's income trajectory and my own genuine desire to be present for those early years. By the time our marriage started to unravel, Ryan had built a genuinely successful career, working his way up to a senior portfolio management role at a wealth management firm. With a base salary plus bonus structure that had grown substantially over the previous 5 years. I had returned to full-time work 3 years before our separation, back in hospital administration, though at a lower salary than I'd have earned had I never scaled back. A gap that economists studying the long-term financial impact of caregiving pauses would tell you is entirely typical and rarely fully recovered. I don't think there was one single moment that ended our marriage. It was, like most divorces I've since learned, a slow accumulation of distance, differing priorities, and a partnership that had quietly stopped functioning as one somewhere along the way. Even before either of us said the word divorce out loud. We separated amicably, or so I believed at the time in the spring of last year, and began the process of dividing our life together through what's called a collaborative divorce process. An approach we both agreed to because neither of us wanted the kids exposed to a bitter, adversarial court battle, and because Ryan, at least in every conversation we had, presented himself as someone who wanted this to be fair, who kept saying things like, "We built this together. We should divide it together." I want to walk through the financial disclosure process in some detail, because it's exactly here, in the mundane paperwork of asset disclosure, that this story actually begins. In our state, as in most states, divorcing spouses are required to complete a formal financial disclosure, a comprehensive listing of all assets, income, debts, and property. Submitted under penalty of perjury, that becomes the foundation for negotiating an equitable division of marital property. Ryan's disclosure, when it arrived through our respective attorneys, listed our joint checking and savings accounts, our house, our retirement accounts, and his investment portfolio at the firm where he worked, along with a modest annual bonus figure that, on paper, looked reasonable given what I understood about his role. The total marital estate, according to his disclosure, came to just over $1.4 million, which we divide roughly according to our state's equitable distribution principles. Adjusted for the fact that I'd be the primary residential parent for Emma and Wesley. I remember reviewing that initial disclosure with a feeling I can only describe as cautious, wary relief. The number felt roughly in line with what I'd expected, based on my own general awareness of our finances over the years. Even though I'd never been the spouse who managed the day-to-day investment decisions, that had always been Ryan's domain, both because of his professional expertise and because, frankly, it had simply fallen into that pattern early in our marriage and never shifted. I want to be honest that this arrangement, in hindsight, was exactly the kind of dynamic that made what came next possible. I trusted Ryan's financial competence completely, and that trust had, over 14 years, translated into a genuine gap in my own detailed knowledge of exactly what we had, where it was held, and how it moved. The specific thing that first made me pause wasn't a dramatic discovery. It was a comment my sister Kate made, almost in passing, during a phone call a few weeks after I received Ryan's disclosure. Kate had gone through her own divorce 4 years earlier and, somewhat protectively, asked me a question I hadn't thought to ask myself. Did you have someone independent actually verify his numbers? Or are you just going off what he submitted? I remember feeling slightly defensive at the question, in the way you sometimes do when someone points at a gap in your own diligence that you hadn't consciously registered. I told Kate that Ryan's disclosure was submitted under oath, that lying on a financial disclosure was itself a serious legal matter, and that our collaborative divorce process was specifically designed to avoid the kind of adversarial suspicion that would require hiring outside forensic help. Kate gently but firmly told me that under oath doesn't mean much if nobody's actually checking, and that in her own divorce, her attorney had specifically recommended a forensic accountant. A recommendation she'd initially resisted for similar reasons before ultimately being glad she'd followed it. I sat with Kate's comment for about 2 weeks before I acted on it, and I want to be honest about why it took that long. Because I think it's relevant to understanding the emotional terrain of divorce more broadly. Some part of me did not want to believe I needed to verify Ryan's numbers. We had, whatever else had gone wrong between us, built our family together in good faith for 14 years. Hiring someone to essentially audit his honesty felt, in a way I struggled to fully articulate even to myself, like an accusation I wasn't sure I was ready to make. Especially given how carefully we'd both been trying to keep the process collaborative and low conflict for the kids' sake. What finally moved me to act wasn't a single piece of evidence. It was a small, specific inconsistency I noticed while going through old joint tax returns to prepare my own financial disclosure, which our process also required of me. I found a K-1 tax form, a document used to report income from certain kinds of investment partnerships, listing a distribution from an entity called Meridian Crest Holdings, LLC, an entity I had never once heard Ryan mention in 14 years of marriage, and one that did not appear anywhere on his current asset disclosure. I asked Ryan about it directly, in what I still believed at the time was a routine, easily resolved question. His explanation was quick, and on its surface, plausible. It was an old investment club he and a few colleagues had put a small amount into years earlier. Something that had mostly fizzled out and wasn't worth much anymore. Not worth including on the disclosure since its value was negligible. I remember accepting this explanation in the moment, largely because it was delivered with the same easy confidence Ryan had always had about financial matters throughout our marriage. A confidence I'd spent 14 years learning to simply trust rather than interrogate. But that K-1 form stayed in my mind in a way I couldn't quite shake. The way a single wrong note in an otherwise familiar song can nag at you even after the song moves on. That evening, I called Kate back and told her about it, and she said something that I've thought about many times since. If it's really worth nothing, there's no harm in getting someone to confirm that officially. And if it's not actually worth nothing, you deserve to know that before you sign anything. I found my forensic accountant, a woman named Priya Chandrasekharen, through a referral from my divorce attorney, who I'd mentioned Kate's suggestion to during our next scheduled call. My attorney, Janet Ferris, told me she'd actually been meaning to suggest exactly this step herself. Given that Ryan's role in wealth management gave him more sophisticated tools and more industry knowledge than the average spouse would have for structuring assets in ways that are difficult for a layperson to trace. It's not that I think Ryan's necessarily hiding anything, Janet told me carefully, but in cases where one spouse has significant financial industry expertise, it's simply good practice to verify independently, regardless of how amicable the process feels. Priya's engagement began with something that felt, at first, almost anticlimactic. She requested 3 years of complete bank statements, brokerage statements, tax returns, and business records for any entity either Ryan or I had any documented connection to, all of which I was entitled to request as part of the formal discovery process our collaborative divorce still legally required, even in its more cooperative format. Ryan's attorney pushed back mildly on the scope of the request, characterizing it as excessive for what should be a straightforward cooperative division, a phrase that, in hindsight, I recognize as exactly the kind of framing designed to make a spouse feel like thorough verification is itself an act of bad faith or unnecessary conflict, rather than simply due diligence. I held firm on the request, largely because Janet coached me through understanding that this pushback on its own was itself worth noting. Even if it ultimately proved to be nothing more than Ryan's attorney's general instinct to minimize document requests as a standard negotiating posture. Priya received the full 3 years of records about 5 weeks later, after some further back and forth about scope, and began what she described to me as a systematic reconciliation process, tracing every significant deposit, withdrawal, and transfer across all disclosed accounts. Looking specifically for what forensic accountants call unexplained cash flow, money that moves out of visible accounts without a corresponding, documented destination in the disclosed asset list. I want to describe the meeting where Priya walked me through her initial findings, because it remains one of the most disorienting hours of my entire life. Disorienting not because the information was confusing, but because of how clearly and specifically it revealed a pattern I had genuinely never suspected in 14 years of marriage. Priya had traced a series of transfers, beginning roughly 2.5 years before our separation. Moving money from Ryan's disclosed brokerage account into a separate account held in the name of Meridian Crest Holdings, LLC, the same entity from the K-1 form I'd found. The one Ryan had described as an old, mostly worthless investment club. According to Priya's reconstruction, these transfers totaled just over $310,000 over that 2.5-year period, moved in amounts and at intervals that, Priya noted, followed a pattern more consistent with deliberate, periodic asset accumulation than with an old, static investment that had simply been sitting untouched. Priya had also, using publicly available business registration records, identified that Meridian Crest Holdings, LLC had been registered not years ago, as Ryan's explanation implied, but in fact registered just under 3 years before our separation, meaning the entity itself had been created during our marriage, at a time when, as far as I knew, Ryan and I had been functioning as a normal married couple with no indication whatsoever that he was preparing for a future in which our assets might need to be divided. I remember asking Priya, somewhat desperately, whether there was any legitimate explanation for this timeline that I might be missing. She was careful and professional in her answer, noting that her role was to present findings, not to characterize intent, but she did note that the pattern, an entity created during the marriage, funded through a consistent pattern of transfers from disclosed accounts, and then omitted or dramatically undervalued on a sworn financial disclosure, was a pattern she had seen before in cases involving deliberate asset concealment ahead of an anticipated divorce. The specific detail that finally, fully convinced me wasn't the existence of the LLC itself, but something Priya found when she dug into what Meridian Crest Holdings actually held. Using a combination of the LLC's own tax filings and property records in a neighboring county, Priya identified that the entity had used a portion of those transferred funds, just over $180,000, to purchase a small commercial property. A property that was generating monthly rental income Ryan had never once mentioned to me, income that had never appeared on any joint tax filing I'd signed. Despite the fact that under our state's tax law, that rental income should have been reported on our joint return for at least the 2 years before our separation, when we were still filing jointly. I want to describe the days immediately following this discovery, because I think the emotional experience matters as much as the financial mechanics. I had spent 14 years believing that whatever else had gone wrong between Ryan and me, we had at least been financially honest with each other. That the trust I'd extended to him in letting him manage our investments was trust that had been, whatever its other costs, at least not actively exploited. Learning that he had spent the final 2.5 years of our marriage quietly building a separate financial life, hidden inside an LLC with a name I'd never heard, funded by money that should have been ours together, forced me to reconsider not just our divorce, but significant portions of our final years as a married couple. I did not confront Ryan directly with Priya's findings before formally presenting them through the legal process, on Janet's strong advice. She explained that presenting this kind of evidence through proper legal channels, as part of a formal motion, would carry significantly more weight, and preserve significantly more legal leverage than a personal confrontation that would simply give Ryan advance warning and time to construct a defense, or worse, attempt to further obscure or move the assets before they could be formally accounted for in the proceedings. Priya prepared a comprehensive forensic report, laying out the entire timeline. The LLC's registration date, the pattern of transfers, the property purchase, the undisclosed rental income, and a calculation of the total value that had been omitted or materially understated on Ryan's sworn financial disclosure, which came to just over $490,000 once the property's current appraised value, the accumulated rental income, and the original transferred funds were all accounted for together. Janet filed a formal motion with the court, attaching Priya's report, alleging that Ryan's financial disclosure contained material omissions and misrepresentations in violation of his sworn obligations under the disclosure process, and requesting that the court order a full accounting along with sanctions for the deliberate concealment. This motion and the report attached to it was the first moment Ryan learned, in any formal sense, that his hidden asset structure had been discovered, and it landed not as a suspicion he could smooth over with an easy explanation over dinner, the way he had with my initial question about the K-1 form, but as a documented court-filed accusation, backed by bank records, property filings, and tax documents that left essentially no room for the kind of confident, reassuring reframing he'd always been so good at. Ryan's initial response, once his attorney reviewed Priya's report, was to attempt a version of the same explanation he'd given me months earlier, that Meridian Crest Holdings was a minor, largely inconsequential investment, that its omission from the disclosure had been an oversight rather than deliberate concealment, and that he was prepared to simply add it to the marital estate for division going forward without any need for further conflict or sanctions. Janet advised me strongly against accepting this framing, for reasons that, once she explained them, felt obvious in retrospect, but that I hadn't fully appreciated before that conversation. An oversight, she noted, does not typically involve creating a new legal entity, funding it through a sustained pattern of transfers over 2.5 years, purchasing a property through that entity, and then failing to report the resulting rental income on a jointly filed tax return, actions that require sustained, active decision-making at multiple points, not a single lapse in memory or a simple clerical error on a lengthy disclosure form. Our collaborative divorce process, which had been explicitly designed around both parties negotiating in good faith, effectively collapsed at this point, converting into a more traditional adversarial court proceeding, since the entire premise of the collaborative approach depends on both spouses actually disclosing accurate information, a premise Ryan had by this point demonstrably violated. I want to note that this transition, while ultimately necessary and correct, was not without real cost. Collaborative divorce processes typically move faster and cost less in legal fees than adversarial court proceedings, and the shift meant a longer, more expensive road ahead for both of us, along with the added strain on our 2 children, who I'd hoped could be shielded from exactly this kind of prolonged, hostile conflict. The court proceeding that followed took just over 5 months to fully resolve, involving depositions, additional discovery requests, and a formal hearing where Priya testified as an expert witness, walking the judge through her forensic findings in the same methodical detail she'd walked me through months earlier. Ryan's attorney attempted several lines of defense during this period, arguing at various points that the LLC's value had been legitimately uncertain at the time of the initial disclosure, that the rental income had been intended for eventual joint reporting once the situation stabilized, and that the timing of the entity's creation, while overlapping with our marriage, did not necessarily indicate any intent related to the eventual divorce. Each of these arguments, when tested against Priya's specific documentary findings, the consistent, periodic transfer pattern that began well before any explicit discussion of divorce between Ryan and me, the property purchase, the multiple tax years where the rental income should have appeared and didn't, grew progressively harder to sustain. The judge's final ruling, issued after the 5-month proceeding, found that Ryan had engaged in deliberate concealment of marital assets in violation of his disclosure obligations. A finding that carried significant practical consequences beyond simply requiring the previously hidden $490,000 to be included in the marital estate for division. Under our state's law, courts have discretion to sanction a spouse found to have deliberately concealed assets, and in my case, the judge exercised that discretion meaningfully. Rather than dividing the previously hidden assets according to the standard equitable distribution formula that had applied to our disclosed marital estate, the judge awarded me the substantial majority of the concealed $490,000 as a specific remedy for Ryan's violation, along with an order requiring Ryan to cover the entirety of Priya's forensic accounting fees and a significant portion of my own legal fees, on the reasoning that these costs had been directly caused by his own deliberate concealment, rather than representing a normal, unavoidable cost of an ordinary divorce proceeding. I want to be honest that even with this outcome, which I recognize as a genuinely favorable and, in a sense, vindicating result, the experience left something in me that I don't think a favorable court ruling can fully repair. 14 years of marriage, and the specific, particular trust that comes from believing your spouse is being honest with you even in the domain you understand least well, is not something a judgment in your favor restores. What the ruling did give me beyond the financial remedy itself was something I've come to value in an unexpected way, a formal, undeniable, legally documented confirmation that what I'd sensed but doubted, the small nagging feeling I almost let go of, the K-1 form I almost accepted an easy explanation for had been correct all along. That my instinct to keep asking, even when it felt uncomfortable, and even when Kate's original suggestion made me defensive rather than grateful in the moment, had been exactly the right instinct to follow. Emma and Wesley are doing well, all things considered. Ryan and I have settled into a co-parenting rhythm that, while not without its own ongoing complications, functions well enough for the kids' sake. And I've made a deliberate choice not to discuss the details of the financial proceedings with them beyond what's age-appropriate, since I don't believe they need to carry the weight of their father's specific choices as part of their own understanding of him. I used a portion of the settlement to complete a professional certification in healthcare finance that I'd been putting off for years, in part because I wanted my own financial competence. Going forward, to never again depend so completely on trusting someone else's account of what we had and where it was. I still work with a financial advisor now, but I review every statement myself, request underlying documentation without hesitation or embarrassment, and check any entity I don't recognize against public business registries as a matter of routine practice, rather than something reserved for moments of crisis or suspicion. If there's one thing I'd want anyone watching this to take from my experience, it's something Kate said to me on that phone call that started everything. A piece of advice I nearly dismissed out of a desire to avoid conflict during what I hoped would be an amicable process. Verification is not an accusation. Asking to independently confirm a sworn financial disclosure, even from someone you've spent 14 years trusting, even from someone who has never once given you concrete reason for suspicion, is not an act of bad faith. It's simply due diligence, the same kind of due diligence any reasonable person would apply to any other significant, binding, legal transaction in their life. Ryan built an entire hidden financial structure on the assumption that a K-1 form buried in old tax paperwork would never surface, and that even if it did, a calm, confident explanation over dinner would be enough to make me stop looking. He had 14 years of evidence that this approach worked, that I trusted his financial judgment completely and rarely, if ever, pushed back on his account of our shared finances. He had no idea that the same trust he'd relied on for over a decade would, in the end, be the exact thing that made the eventual discovery land so completely. Because once I finally did look closely, I wasn't looking as someone learning to distrust him for the first time. I was looking as someone who had spent 14 years paying close attention to everything else in our life together, and who had simply, finally, decided to extend that same attention to the one domain I'd always left entirely in his hands.